How are you all doing? Stepbro Dan here, and today my stepbros and I will be discussing the topic nature and scope of partnership operations. Now, before we discuss this, let us have a brief overview of what a partnership is. A partnership is an agreement between two or more people to share ownership in a business of their interest and share the responsibilities and the profits and losses of the business. Partners, or the people in the partnership, are considered the owners of the business. All assets contributed to the partnership are recorded at the agreed upon value, otherwise known as the fair market value, and liabilities are recorded at their current values, otherwise known as the present values. The accounting process for partnership operations is similar to the process of accounting for a sole proprietorship. The difference is with the distribution of profits and losses and with the responsibilities of each partner in the partnership. In a sole proprietorship, the owner reaps all the profits but is also responsible for the liabilities of the business. In a partnership, the partners make an agreement regarding the profit and loss distribution and the roles of each partner. The profit and loss distribution can be based on the capital contribution of each partner or the amount of responsibility they hold in the business. This could also be distributed equally or however the partners agreed to split the profits and losses. Each partner has different roles and different responsibilities that come with these roles depending on what type of partner they are in the company.
So the next topic is partnership operation. So in terms of recording the business operational activities, partnerships pretty much resemble the procedure in a sole proprietorship form of business. Like for example, let's say that the partnership purchased office supplies from a dealer. So you debit office supplies. Cost to increase this account, you need to debit assets. And to pay off this purchase, you decrease cash by putting it on the credit side. So another example is what if the partnership sold merchandise? You record it the same way as you did in a sole proprietorship. So you debit cash because you sold merchandise, therefore you get some money, and you have to credit sales to increase the equity of the partners. And what if it's sold on account? Simple, just debit accounts receivable to increase assets, and then credit sales to increase partners' equity. So next is the accounting cycle of the partnership. So as mentioned earlier, the business operation of a partnership is pretty much similar to a sole proprietorship. Their similarity includes the accounting cycle. So the procedures that are under the accounting cycle of the partnership are analyzing business documents and recording of the business transactions, posting to ledgers, preparing a trial balance, preparing a worksheet, recording adjusting entries, preparing financial statements, recording and posting closing entries, preparing a post-closing trial balance, recording and posting reversing entries. So just to point out, their accounting cycle may be identical, but in some ways they differ in the preparation of financial statements. So now, I'm going to discuss preparing financial statements for partnerships. So note that preparing financial statements of a sole proprietorship form of business is pretty much the same that of a partnership, except for the following: statement of financial position, income statement, and statement of changes in owner's equity. So starting off with the difference in the statement of financial position. So the statement you see in your left is the statement of financial position of a sole proprietorship form of business, and to your right is for partnerships. So basically, the difference between the two balance sheets is the label in each of the equity section. So in the balance sheet of the partnership, you'll just simply replace owner's equity with partner's equity. And almost forgot, they do have a difference in the equity section. So the partnership would have more than one capital account in that section. So the next is the difference in the income statement. Same thing to your left is for the sole proprietorship form of business, and to your right is for partnerships. In the income statement, they pretty much look identical, but in the income statement of a partnership, there will be an additional section called the distribution of net income or net loss if the business incurred a loss. In this other section of the income statement, the distribution of profit or loss will be presented in full detail on how it will be distributed. So there will be different factors that will affect the distribution of these gains and losses, such as the salary of the managing partner, the agreed upon interest due to the beginning capital, the agreement about the profit sharing ratio, and etc. But in our case, we just utilize the profit and loss sharing ratio, which is 2 is to 1 is to 1. Lastly, the difference of the statement of changes in partners' equity. So obviously, the difference right off the bat is that in a statement of changes in equity, for a partnership deals with more than one owner, and for the sole proprietorship has only one owner. So in this statement of changes in partner's equity, the statement will report the changes that have occurred in the partner's equity within a period, such as net income or loss and drawings of the partner. As you can see, each partner has his or her own column heading in the statement. Along with that is the changes in each of their equity account. So add net income, then less drawing, or net loss and then less drawing, and so on and so forth. So the next thing I'll discuss is the accounts used in partnerships. So the accounts used in partnerships are the following: capital accounts, drawing accounts, and loan accounts. So starting off with the capital account. So as you can see there, there's a table splitting two sides. So to your left is the debit side and to your right is the credit side. So before starting, I just want to have a quick recall on what increases and decreases a capital account. So the capital account by nature would only increase if the account is placed on the credit side and decrease if the account is placed on the debit side. So everything on your left will be the cases when the capital will be found on the debit side and in a partnership, and same goes for the ones on the right. So the first is when a partner makes a permanent withdrawal. So in this case, a partner would recall all of his or her own capital from the partnership. So usually this is seen when the partner intends to leave the partnership. So he takes all of his capital in the partnership, therefore it would decrease his capital and decrease the cash of the partnership. So next is retirement or selling of interest in the partnership. So in this case, a partner will retire from the partnership. So therefore his capital account will be recalled from the partnership for his retirement. And next, if a partner will be selling his interest to another partner or another upcoming partner. So by selling his or her own interest, he would decrease his capital account. So next is the distribution of loss. So when the business operation results to a loss, the partners would distribute these losses to each partner according to the agreement of the partnership, therefore decreasing their capital account. Now for the credit side. So this side will initially increase the capital. So starting off with the investments of a partner. So first of all, the investments may come in different forms. It may come in cash, land, equipment, and etc. So when a partner invests in a partnership, his or her own capital account would increase because of the additions to the assets. Next is the payment of the partnership to a certain partner. So probably due to a loan. So when a partnership borrows money from you, they are obligated to pay you in a future date. And when the future date is reached, the partnership would now pay the partner who lent the money, therefore increasing his or her capital account. Lastly is the distribution of profit. Just like the distribution of loss, this is shared among the partners. So when a business operation results to a profit, Partners would then divide these profits among themselves according to the agreement of the partnership, so therefore increasing their capital accounts. So the next is the drawing account. So same thing. To your left is the debit side and to your right is the credit side. Starting off with the debit side. So in the case of temporary withdrawals, so when a partner withdraws a part of his capital from the partnership, the partnership would decrease in cash by drawing. But to see the effect of these on the capital accounts, this will be seen in the statement of changes in the partner's equity. And lastly, in the debit section is closing of credit balance to the capital account due to the retirement or sale of the interest in the partnership. Next is the credit balance. So these are the following cases that would decrease the drawing account. So allowance for salaries or bonuses which are part of the share in the profit or loss of the partnership. Interest on capital as stipulated in the partnership agreements. And lastly is the closing of debit balance to the capital account due to the retirement or sale of interest in the partnership. So lastly is the loan account. So basically the difference between these two are who will loan and who will repay the loan. So starting off with the receivable from a partner. So if a partner were to be in need of cash, the partnership itself could loan some cash to the said partner without treating the loan as a withdrawal of the partner. So like most loans, every borrower is obligated to pay off the debts to its creditors. So every borrower must pay the creditor at a future date. So the loan provided by the partnership to a partner would be seen as receivable, an asset. So this will be presented in the balance sheet. So for example, X is in need of money, so he decided to borrow some cash from the partnership and is part of. So he borrowed 50,000 pesos. You debit the receivable account to increase the asset since the partnership will assume the loan will still be of use to them. Then decrease the cash by putting it in the credit side since the partnership will lose some cash to lend to XZ. So next is payable to a partner. So if ever the partnership were in need of cash, a partner may cover the finances of the partnership. The partnership will be getting a loan from a partner, and the partnership will be obligated to pay off the loan to the partner at a future date. So this loan will be considered a liability of the partner. It will be seen as a payable and is to be presented in the balance sheet. So for example, Kingsman Limited needs 200,000 peso worth of cash to pay off multiple expenses of their partnership. So Eggsy is willing to provide the finances to the partnership. Kingsman Man Limited loaned 200,000 peso from Eggsy. So since the partnership will be receiving some cash from a loan from Eggsy, the partnership cash will increase, pouring on the debit side, and then their payables will too increase due to the transaction or the case.
Next topic will be the problems found only in partnership operations. Starting off with loans. Partners may borrow cash from a partnership and vice versa. In recording a loan from the partnership to a partner, cash will be credited since it will be lent out to a partner, and a receivable account would be recorded because the partnership expects the partner to pay back the loan. On the other hand, when a partner gives the partnership a loan, cash will be debited since the loan will increase the assets of the partnership, but there will be an increase in payables since it is a loan and the partnership is expected to pay the partner back. The indirect method of closing accounts is used in the closing of entries for a partnership. In the indirect method, net income or net loss is closed against the drawing account before the drawing account is closed against the capital account. Net loss will be closed against the drawing accounts if the income summary has a debit balance. The income summary will then be credited and the drawing accounts of the partners will be debited in the closing process. Net income, on the other hand, is closed against the drawing accounts if the income summary has a credit balance. The income summary will then be debited and the drawing accounts of the partners will be credited in the closing process. after which the balances of the drawing accounts and the income summary will be updated. And then we can proceed with closing the drawing accounts against the capital accounts.
My name is Simon Chen, and today I'll be discussing the distribution of profit and loss depending on the different kinds of partners. First, there are two partners. The first one is the capital partners, and the second one is the industrial partners. So let's go. In the capital partners, the division of profits there's two ways. First, in accordance with agreements between the partners. In the absence of an agreement, the division of profit is in accordance to capital contributions. Now, let's go to division of losses. In division of losses, the division is based on capital contribution or in accordance with agreement or in the same agreement with the division of profits. Now, the industrial partners. The industrial partners division of profit could be distributed a just and equitable share under the circumstances or in accordance with agreements. In the division of losses, it can be in accordance with agreements or no loss to be distributed. Now, the methods of dividing net income. It can be divided equally among the partners or it can be divided in arbitrary ratios like fractions, percentage, ratio, and proportion. It can also be divided based on capital ratio, like original or initial investment, beginning capital balances or ending capital balances, or the average capital balances. Now, let's look at one of the examples. As you can see on Richard Capital, from January 1 he has 2.5 million, on April 1 he has 250,000, and October 1 he has 500,000. You add it all up minus the 100,000 debit side, you have a balance of 3,150,000. Richard drawing from January 1 to December 31 is 300,000. Now in Stephen Capital, you can see that from January 1 September 1 he has 2 million minus the debit side, so you can get a balance of 1.8 million. He drew 225,000. In the income summary, you can see that the partners made a profit of 600,000. Now example, case 1, profit is divided equally. So since it's equally, there are two partners. So all you have to do is 600,000 divided by 2, you get 300,000. So each partner gets 300,000. On the arbitrary ratio, the profit is divided by 45% and 55%. 45% to Richard and 55% to Steven. Now, you debit income summary 600,000. 600,000 times 45% is 217,000. That's Richard's capital. And 600,000 times 55% is 330,000. That's Steven's capital. Now, based on capital ratio, profit is distributed based on the beginning capital ratio. Now, the beginning capital ratio for Richard is 2.5 million. The beginning capital ratio for Steven is 1.5 million. So you can see, since the income is 600,000, all you have to do is 600,000 times 25 over 40 is equal to 375,000. That's Richard's capital. And Steven's capital, you can do 600,000 times 15 over 40 is equal to 225,000. That's Steven's capital.